Welcome back to Smart Stock Sam, the channel where we cut through the noise, follow the real data, and find the setups that actually matter before the crowd catches on. I am Sam. Today we are going deep on SoFi Technologies in mid-2026. We are going to expose the record growth that Wall Street is conveniently ignoring, tear apart the terrifying short seller report that has retail investors running for the exits, and reveal the massive asymmetric setup that could define this stock for the rest of the year. Whether you already hold SoFi, you are thinking about buying the dip, or you just want to understand why a company with this kind of fundamental strength can get hammered this hard, you are in exactly the right place. Let us get into it. So here is the contradiction that should be making your head spin. The stock is down 32% year to date. If you only looked at the price chart, you would assume this company is collapsing. But then you look at what the business is actually doing, and it tells a completely different story. Revenue has surged 42.6% year over year. Operating margins have expanded from 10% all the way to 18%. And that margin expansion has driven a 150% explosion in operating income, all the way to $200 million in a single quarter. And while everyday retail investors are panic selling on scary headlines, institutional money is sitting at nearly 38.5% ownership. But perhaps the loudest signal of all? The CEO, Anthony Noto, has taken over $2.25 million of his own personal money and bought his own company's stock this year alone. Not a corporate grant, not a stock option, his own cash. Now, before we get too comfortable in the bull case, I want to be upfront. There is one hidden metric buried in this story that changes the entire risk picture, and we will get to that. But first, let us understand how we got here. I call this the Great Divergence, and once you see it, you cannot unsee it. Picture two lines on a chart. The red line is the SoFi stock price, falling off a cliff, down 32% in just a few months. The green line is the actual underlying business. 10 consecutive quarters of GAAP profitability, $1.09 billion in quarterly revenue, and an organically grown user base of 14.7 million members. Same company. Two lines moving in completely opposite directions. Now here is what history tells us about moments exactly like this one. When fundamentals trend upward while the stock trends downward, the market has created what traders call an elastic band effect. The further those two lines pull apart, the more energy builds up between them, and eventually, not if, but when, that band snaps. The question every investor needs to answer is, which direction does it snap? Does the price catch up to the business? Or does the business collapse down to where the market has priced it? To answer that, we need to understand exactly what this company delivered in its most recent quarter. Q1 of 2026 was not a good quarter for SoFi. It was a record quarter. Revenue came in at $1.09 billion, shattering Wall Street's consensus estimate of $1.05 billion. Earnings per share hit 12 cents, cementing that 10th consecutive quarter of GAAP profitability. They added 1.1 million new members in just 3 months, pushing the total to 14.7 million. Loan originations hit an all-time record of $12.2 billion. But here is the metric I want you to lock in on, because it is the gold standard for growth companies. SoFi has now exceeded the Rule of 40 for 18 consecutive quarters. For anyone unfamiliar, the Rule of 40 says that if you add a company's revenue growth rate to its profit margin and that number comes out above 40, you have a business genuinely balancing aggressive growth with real profitability. SoFi's combined score right now is 44. 18 straight quarters above that threshold is not a fluke. That is structural excellence. But can they sustain it? That is where things get really interesting. The concept driving SoFi's profit story right now is structural operating leverage. In plain English, it means that as revenue grows, costs do not grow at the same rate. When SoFi grew revenue by 43% to $1.09 billion, they did not let operating expenses run wild with it. They held a tight leash, keeping total expenses at $890 million. Because revenue exploded while costs stayed disciplined, their operating margin nearly doubled, from 10% to 18%. That single dynamic produced the 150% surge in operating income. Think about what this means for the long game. Every incremental dollar of revenue SoFi generates from here is dramatically more profitable than the dollar before it. Legacy banking incumbents have spent decades building this kind of efficiency. SoFi is getting there in years, not decades. They are not buying growth with reckless spending. They are earning it through genuine, structural efficiency. But controlling costs is only half the picture. The other half is how cheaply they are acquiring new customers in the first place. So, Fi's most underrated weapon is what I call the super app flywheel. They are not trying to be just a loan company or just a brokerage. They want to be the one financial app you never need to leave. And right now, they have three enormous catalysts pulling in new users. First, SoFi became one of only 5 brokerages in the entire country to offer retail investors direct access to the SpaceX IPO. Think about how many millions of people who have never even heard of SoFi will download that app just for a shot at owning SpaceX before it goes public. Second, they are launching SoFi USD, the very first stablecoin issued by a United States national bank, enabling faster, global, one-to-one redeemable payments on the blockchain. Third, SoFi Coach, an artificial intelligence-powered financial assistant that tracks budgets, drives daily engagement, and naturally cross-sells users into high-margin products like personal loans and mortgages without ever feeling pushy. The flywheel works like this. You download the app for SpaceX access. You stay because the AI coach is genuinely useful. 6 months later, you take out a personal loan because it is right there, one tap away. Customer acquired, lifetime value unlocked. But the biggest historical bear argument against SoFi was never about the app. It was always about the balance sheet. For years, critics said SoFi was holding too many loans on their own books. If the economy turned and people defaulted, SoFi would be left holding the bag. It was capital intensive and risky, but SoFi has executed a brilliant pivot toward what they call the loan platform business, or the LPB. Instead of holding every loan, SoFi originates the loan and immediately sells it to third-party institutional giants like Fortress or Blue Owl. SoFi collects a fat facilitation fee and retains zero credit risk. Zero. None. In Q1 alone, originations through this platform hit $3 billion, a 90% year-over-year increase. The annualized run rate is now $775 million. This is pure, capital-light fee revenue. It is the exact type of business model that commands premium valuations, because you are making money without putting your balance sheet at risk. And it directly dismantles the longest-running bear argument about reckless credit exposure. But if the business is this well-structured, why has the stock been destroyed? This is where the story gets dark. A well-known short-selling firm called Muddy Waters Research dropped a bombshell report accusing SoFi of what they called Enron-esque off-balance sheet structures, alleging $312 million in unrecorded debt and disguised borrowings used to artificially inflate financial metrics. SoFi denied everything, citing strict GAAP compliance and direct Federal Reserve oversight. But here is the uncomfortable truth about how markets actually work. It does not matter if the accusations are true in the short term. The moment the word fraud appears in a headline, retail investors panic and sell. And that is exactly what happened. On top of that report, there are legitimate macro risks here. Annualized charge-offs on personal loans have crept to 3.03%. Total shares have ballooned to 1.28 billion following a capital raise. And with the Fed keeping rates higher for longer, loan demand could slow while funding costs stay elevated. These risks are real, but here is the thing. Risk always has to be weighed against conviction, and the most powerful signal of conviction in the entire stock market is sitting right at the top of SoFi's organization chart. While short sellers were screaming accounting fraud, CEO Anthony Noto was buying. He bought in March at $17.88 per share. He bought again at $17.32. He bought in May at $15.85, and on June 16th, he purchased another 13,888 shares at $18.06. In total, Anthony Noto has deployed over $2.25 million of personal capital into SoFi stock in just the first half of 2026, bringing his total direct stake to 11.96 million shares. And I want to make this crystal clear. Executives sell stock for 1,000 different reasons: taxes, diversification, buying a home, but they only buy on the open market when they genuinely believe the price is going higher. You cannot fake that. That is real money, real conviction, and real skin in the game, and he is far from alone. While retail was selling, institutional capital was quietly doing the exact opposite. Total institutional ownership sits at 38.43%, and in Q1 of 2026, the additions were staggering. Cube Research and Technologies grew their position by 391%, adding over 13.3 million shares in a single quarter. Advanced Portfolio Management increased holdings by over 266%. Even legacy giants like UBS and Jane Street Group added millions of shares to their portfolios. Here is the thing about institutional investors. These are teams of analysts, portfolio managers, and risk officers who dissected the Muddy Waters report line by line. They ran the numbers, they stress-tested the accounting, and their collective conclusion was to buy more. The smart money is not running from the Muddy Waters report. They are using the panic it created to accumulate shares at a steep discount, while retail investors hand them over out of fear. Now, if you want to know the true floor value of a bank, you look at tangible book value, the hard asset value after stripping away all the goodwill and intangibles. SoFi's tangible book value sits at $7.21 per share. At current prices, the stock trades at roughly 2.5 times that figure, entirely reasonable for a hyper-growth fintech with this kind of momentum. The net interest margin tells an even more compelling story, sitting at 5.94%. That figure proves SoFi has an exceptional and widening spread between what it costs to borrow and what it earns by lending. And that margin strength exists because SoFi grew member deposits 2.2 times over 2 years to $40.2 billion. $40 billion in low-cost funding sitting inside their own ecosystem, completely insulating them from expensive market debt. That is a genuine competitive moat. Wall Street is divided on what all of this is worth. The bulls have a fair value target of $22.98. They see a true fintech super app, a unified ecosystem where every product reinforces every other product, driving acquisition costs down and lifetime value up. Their model assumes sustained 20% revenue growth and margins expanding to 20% by decade's end, powered largely by the loan platform business. The bears, on the other hand, slap a fair value of just $14 flat on the stock. They see a cyclical lending bank in tech clothing facing severe macro headwinds, margin compression, rising default rates under higher-for-longer Fed policy, and fair value loan accounting that could unravel badly in a recession. Both cases are coherent. Both deserve respect. Where the stock actually goes depends on which reality plays out first, and the technical setup is about to give us a very important clue. Right now, SoFi is trading around $17.91, having just broken above its 50-day moving average at $16.90. More importantly, the stock has built a massive double-bottom support right at $14.97. Tested, held perfectly, and bounced cleanly. Now, there has been enormous chatter about a short squeeze. Let us look at the actual data. Short interest is elevated at 14.74% of the float E. That is real. But the borrow fee rate is sitting at just 0.25%. That is basically nothing. It means short sellers are facing virtually zero financial pressure to cover their positions. A traditional, forced short squeeze is highly unlikely right now. But here is where things get genuinely exciting. There is a massive options wall sitting at the $20 strike price. If SoFi catches upward momentum toward that level, a gamma squeeze kicks in. Market makers who sold those call options are forced to buy millions of shares to hedge their exposure, creating a self-reinforcing buying cascade that could pull the stock like a magnet toward that $20 neckline resistance. That is the real technical catalyst to watch. Before we wrap up, these are the 3 metrics you must monitor every single quarter. Net interest margin versus funding costs. Watch whether SoFi can protect that 5.94% spread. Default and charge-off rates. If that 3.03% number spikes significantly, it directly threatens tangible book value. And loan platform business continuity, the $775 million run rate is the proof that this capital-light pivot is working, and it must hold. Now, before I give you my final verdict, I want to be completely transparent, because transparency is what Smart Stock Sam is built on, and it is the only way to build genuine trust in this space. Everything in this video is purely for educational and informational purposes only. Nothing here is financial advice, investment advice, or a recommendation to buy or sell any security. I am not a licensed financial advisor. All investing involves risk, including the potential loss of principal. Please always do your own due diligence, consult a qualified financial professional, and never risk money you cannot afford to lose. Past performance never guarantees future results, and the stock market can be wildly unpredictable, even when the fundamentals look perfect. Here is the bottom line. SoFi in mid-2026 presents one of the clearest fundamental disconnects I have seen in this market in a very long time. The stock is priced for catastrophe. The business is delivering record growth, expanding margins, $40 billion in low-cost deposits, and relentless insider accumulation from the CEO himself. The combination of structural cost leverage, ecosystem expansion through the SpaceX IPO access and SoFi USD, and deep, consistent insider conviction creates a risk-to-reward setup that is genuinely difficult to find anywhere else right now. This is not just a bank, it is a compounding machine currently on sale. But here is my question for you. Do you think the Muddy Waters allegations have permanently damaged SoFi's credibility with Wall Street, or do you believe the business fundamentals eventually win and force the stock higher? Drop your answer in the comments below. I read every single one, and I would genuinely love to hear where you stand on this. If this deep dive helped your research, please hit the like button. It genuinely helps more investors find this kind of analysis and keeps this channel alive. And if you are not subscribed yet, hit that subscribe button and ring the bell so you never miss a setup like this one. If you want to go deeper, real-time watch lists, early breakdowns, and a community of serious investors all growing together, the Smart Stock Sam exclusive membership is live right now, and the link is in the description below. Come join us, level up your investing and trading, and let us build real wealth together. You can also support the channel directly by sending a super thanks right below this video using YouTube's support feature. It means the world and keeps this content coming. As always, manage your risk, protect your capital, and I will see you in the next one.